You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is financial consultant and wealth manager Richard Knowles of Knowles & Associates in Vancouver. Welcome to the show, Richard.
Thank you for having me, Jim.
Plunge of the Ruble. People apparently are storming stores in Russia for high-end items like cars and appliances before the prices go up again, and they're saying this could lead to a full-blown rush on the banks.
We're looking at 1998 all over again, really. There's two things that happened in 98 that were really clear to the world, and we have carried from that year. The ruble crashed at that time, and also oil hit around $20-something a barrel. So there have been speculations by a number of people just this morning. You know, there were some questions. What do you think oil is going to hit? And a number of people in the news today talking about it. And some are saying it could stabilize where we're at, and some are forecasting it could drop down to $20-odd a barrel again. And with this kind of correction, you know, there's two things we can say. One of doom and gloom, which is, oh my goodness, we're going into a precipitous year in 2015. But the flip side to that, the greatest thing I think anyone can take away from this is look back to 1998 and look at some of the major returns we've seen since then. Now, it has been a very riotous decade, to be honest, in the last decade. Think about it. After 1998, which was the global collapse of the ruble, and a number of other issues in that year. Of course, oil dropped. One of the biggest boom years we've seen after that was 1999 and then year 2000. But of course, that was the tech bubble that occurred in 2000. We had a crash in the stock markets. But it wasn't because of these reasons, so oil and ruble, etc. It was the tech bubble. And then when that happened, we had 2 years of a severe recession. 2001, 2002 was a global recessionary period. And then in 2003, we had this massive recovery. And then from then on, between 2003 and 2007, we had great markets for 4 years. And then we hit 2008, and we're still doing great up until about July of 2008. So we had about 5 years of great markets, great economic growth, good numbers on the table. And then we have a banking crisis because of the propped up fake mortgages and things that JP Morgan and Jamie Dimon were willing to sell to unsuspecting banks and just completely eradicate the global financial markets. Had that not happened, we still would have hit a recessionary cycle. So if we had continued on and we did not have the crash of 2008, it was very likely by 2009 we would have had a slowdown in economies worldwide anyway, because typically 6 to 7 year cycles in recessionary cycles are very typical for the global economy and certainly for the North American economy. And this is not atypical simply because it's I like to look at it as a runner running forever. You know, I mean, you can't continue to run at high speed, so you end up slowing down. So it's a recessionary cycle. Doesn't mean we go into a deep recession if it's a normal recession, but it does happen on regular intervals. But this was precipitous, the one in 2008, because of the banking crisis, which created this massive catalyst for a global, not only the normal recessionary global correction, but it created this fantastic benchmark moment where the globe realized just how dangerous the world really has been built to be. Now, with all of these, dangers that we can say, about the way the banking system is set up, and too big to fail came out from that expression. This bank is too big to fail, so the governments will be there to bail them out, which means really it's the taxpayer, I
was going to say, Richard, the banks right now are exposed to horrific risk from oil derivatives. And it's just like back when they did the fake mortgages, only this time oil is not worth the price of the loans they put out.
Yes and no. It is a really different animal at this time. With oil derivatives, it's really just being caught on the short end of the stick when the pricing movement went the wrong direction. So you're banking on a certain direction on the oil, and then you can get caught on that. That's still a legitimate product, whereas, that's a legitimate risk that you can hedge if you know what you're doing. The key is that the bank system back in 2008 these were fake products that were being sold by registered financial investment organizations, and they knew they were selling them, and they knew they were fake. But the worst part of that story in 2008 is nobody's actually been held accountable for this. So there is no fear to let it happen again. And that's actually the worst part of the story. While it happened, we've dealt with it for the most part, but it's all still a Band-Aid. It looks good, but the cancer is in a sense still inherent in the system because the people that caused it aren't being held accountable. No, Jay Diamond should have gone to jail, not get a $20 million. This is a big opinion, but a man like that who represented this failure and is known to have known about it prior to it happening and continued to sell the products, and there's witnesses to that.
Well, both Canada and I was going to say, Richard, both Canada and U.S. have put in legislation where they said, oh no, if we have to bail out a bank, it won't be the taxpayers, it'll be the account holders. Just like they did, the CREET haircut.
Passing the buck, I know. But in the end, these big banks, J.P. Morgan, which is an investment bank, the whole system is basically rotten. Ever since they brought down the wall between investment banking and actually traditional banking, and they let everybody do anything they want, it became a Western, where all the cowboys are coming in and having their whiskey whenever they want, and it's a crazy kind of Western, nutty kind of story now. And when they did that back in the late 90s and early 2000s, and they took away I forget the act. I'm just running a bit blind here. But when they prevented that, the separation of the two types of banking systems, that's when the failure started to become inherent in the system. Hillary Clinton, many of the top leaders in the U.S. have been very vociferous against that and wanted to re-implement that guardianship between the two banking systems to protect against this kind of failure of guardianship. And they're fighting for that now, and hopefully they get it because it's about time. Frank Dodd is what I'm thinking of. So in any case, that I'm just sort of looking at the history, and now we're now back in another 7-8 year cycle after 2008, 2015 entering, and we have another catalyst, the ruble and the oil, again in tandem, happening together, where the oil's being allowed to drop. The Saudis, it only costs them $6 a barrel to get oil out of the ground. Basically, that's the bottom line. So they don't care if it flows to 20 because they want to maintain control in OPEC. And they're sending a message to their other OPEC partners. There were some discussions about this yesterday. They're sending a message to the other OPEC partners that, look, we're here. Saudi's here. We control the taps. So let's, work together. And they're also sending a message to Russia, which is basically an oil nation. And now they're entering one of their coldest winters, we think, and the ruble's going down. They can't sell their oil for a lot of money, so their economy is trading, if you will, through the ruble in the same fashion. So without oil there and without the income from oil, the Russia looks pretty bad as a currency, so it's being sold off. And in fact, just recently, Vladimir Putin and the central banks in Russia boosted the interest rates up to 17% from 10% on their debt. So that's, if you want to buy good debt, do you go there for 17% or do you run the other way because the currency is just dropping like crazy? So it's a desperate attempt to try and support their currency, and they're going through this crisis again in Russia. But from all of this, the positive news is we will recover. We've seen it happen in 98. We've seen it happen again after the tech crash. The key is how to build a portfolio to be diversified enough that you can weather these storms and avoid these great trips into the netherworld for long extended periods of time. And people forget that there's a whole series of investments that you can be involved in that have no risk, if you will, of your principal. You can insure them to some degree. You can insure your principal and insure the growth of your investments, even if you are involved with stock markets. And these kinds of things are very rarely talked about and just not talked about enough. But it's a wonderful opportunity when you see these things happening to remind yourself that there are alternatives to the simple chasing of a stock on the stock exchange with all of its inherent risks. Yes, there can be great glory by chasing a single stock that you think is a small cap and you want to take a big chance and you've got the money to throw at it. But it's the same kinds of risk that we feel and the same kinds of glory as well that we feel when we run out and we buy a Lotto 649 ticket and then we win something. But you have to remember that you always have to add up your wins and losses. Anybody that plays the lottery game and has fun doing it, I'm happy for them. But if you look at the numbers you put into the lottery tickets you buy to get that big winner and the amount of money you actually will win over time is usually you're putting in more money than you're winning. And you're doing it as a game. It's not really to win. And this is the same kinds of risks that people forget exist in very high levels in stock markets. So the real way to make money, you have to be very cautious, and you have to know how to build up a diversified portfolio, and you have to know how to defend that portfolio in downtimes. And without that information, unfortunately, many day traders think that they can trip into a day trade, and as soon as it starts to turn, just sell it, or put a stop loss on it or something, and they just feel, oh, if I do that every day and I make 1% a day, guess what? By the end of a 200-day average working year, I'm going to have 200% return because I always stop my losses. But we all know that's impossible. It just never happens like that. So the key to take away from this, I think one of my Christmas messages, if you like, that I'm sending out to my clients is use this time to revisit the risks of our lives, because on a macro scale, we have it on our micro scale. We should be looking at the world and its risks today. Yes, it will end. It's not the end of our lives, although maybe some people will die in a cold winter in Russia because they won't have oil and they can't afford to buy it. And that in and of itself is a very sad story. But the truth is, this is the time of year we tend to look at these things. And I think that it's important for each one of us to look at our life insurance and our disability, revamp our risk management, as well as looking at how do we really manage our money. Forget about the individual tools we're using. Is this the right stock, or is this the right fund, or is this the right ETF? Get away from that kind of argument and look at your portfolio sensibly. Have you diversified it properly? Do you have a method to manage it? Because people forget they're just supposed to manage your money. They think it's just a big bunch of money you just invest and keep moving. Any businessman that has a business, that has his money invested in his business, knows you've got to manage your business so that you can make a profit. And if you're not doing it right, you get the advice in to do it. And that's success. That's a good, successful man or woman that does this, that runs their own businesses, knows how to do this. And it's that kind of thing that this is a very important time to remind us to come back to the important issues of your portfolio management and how you've been doing it right, and your whole financial picture.
We'll have more with Richard Knowles after the break.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're talking to Richard Knowles of Knowles & Associates in Vancouver. Richard, you said it's important to take a look at end-of-the-year tax breaks that are available.
Yes, no, this is a great time. We do a typical tax review for our clients and for my people. This is an important time to review whether you've triggered any capital gains or losses throughout the year in your open, non-registered accounts. Things like TFSAs, tax-free savings accounts, and RSPs, of course, are tax-sheltered while we're trading inside them, so there are no exposure to that. There is no exposure to taxes, I should say, in these accounts. However, for open investments, things in cash accounts, trading, mutual funds that you may have been trading and holding for a period of time, you get different types of tax events. So you could have dividends being paid out, you could have capital losses or capital gains throughout the year that you've triggered through buying or selling. And by looking at that before year end, you have an opportunity to see if you've created any capital gains that will otherwise now be taxable to you. Now, a good example of that would be this very important thing, I should say, at this point, because an example of that is this with this oil crisis that's going on. I don't know that by the way, I wanted to point out that it's not an oil crisis, it's an oil benefit. One of the greatest things we have to realize is that with lower prices of oil, the consumer is the winner. When you have a winning consumer, you have more cash in their pockets, and that benefits the whole economy in the long run. Now, we may not see it if oil stays down this low, for the next month or two, but certainly for a long period of time, if it lasts 6 months or longer, arguably even a little less than that, this could be a massive takeoff of our economic conditions worldwide, because people will have a lot more money in their pockets, as well as companies that transport and use gasoline all over the world. So in any case, I digress. One of the best parts of this story is that you can trigger some tax capital gains or losses at this time to offset any gains, I should say losses, to offset any gains you may have created during the year. And this way, your investments, while they may be down at this time, may actually still have had some capital gains. This would be the opportunity with this lower market to trigger an intentional capital loss. And you have to remember the rules. You have to stay out of your investment for 30 days to qualify and make sure that the capital loss stays on the books. If you come back into the same investment within a 30-day period, Revenue Canada or CCRA may overturn the tax loss. So you do want to watch that period of time. But once you clear that benchmark and you are willing to stay out of your investment for that period of time, or you may have an alternative you'd like to buy, that will trigger your capital loss. It can stay on the books, and you can offset your other capital gains that year. So you can have a nil. If you do it right, you'll have a null effect, and maybe even a capital loss to carry forward into the next year for other capital gains you may create. So this is that time. You should be looking into your portfolio and getting a hold of your advisor to find out if there's any way to mitigate any capital gains. Make that call or get your accountant to do so prior to the end of the year, because you only have to the end of this calendar year to trigger that loss, to regain those capital gains you may have created.
Great advice, Richard.
My pleasure. Thank you, Jim.
You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. We're also available on YouTube channel Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.